stocks continue to crash. I'm going to give you 5 stocks that are down over 75% this year. You're going to be amazed by these names. First one, Carvana. Carvana is only down 91% in a year and 50% on the month, 23.5% alone today. Let's look at the 8 pillars on this thing. It's a disaster for them. 5-year PE, they don't have one. 5-year price to free cash flow, they don't have one. Negative free cash flow, the debt situation is terrible. They, as a shareholder alone, they are diluting the absolute heck out of you. 575% new amount of shares. They do have revenue growth, however. And remember, this is a new company, so I'm not going to crush them for what they're doing here, but I am going to crush them for this. They took off in a very, very easy time for basically the world. I mean, people were making money hand over fist during COVID, and they were one of these COVID stocks. So it's not totally surprising that they're coming down. Let's see what analysts say going forward. I have heard a lot of things about Carvana having so much inventory that it could sink them. Now, earnings per share growth over the next 5 years. And I think 5 years is a good thing to look at here, not going out 10 years. Negative earnings per share 5 years out. Now, revenue growth, they do see revenue growth. Analysts see, granted, it's only 14 analysts, but they see 20.5% revenue growth going forward. They're sitting in that 20% range. So when I type it in the stock analyzer tool right now, I'm going to go 20% on the high side just to give them the benefit of the doubt. So 10 years, let's go. 20% on the high side, 10% on the low side, 15% in the middle. Profit margin. I don't know what kind of profit margin this company can do. I'm going to do a wide range here just because we truly don't know. They're kind of with that CarMax, but they're also down a lot. So let's go in here and let's put in a profit margin of 5, 10, and 15. It's just a big, big range, but let's see what comes out. PE ratio. I will give them PEs of 17, 19, and 21. 17, 19, and 21. Desired annual return, 15, 20, and 25%, because I have no idea what's going on. And I actually, for me to get a price of 15, I need to have something. It's all in the money. It's if you think that my numbers are accurate, then this is a buy all day for you. If you think that they can do 10% revenue growth, 5% profit margin, 5% price to free cash flow, etc., then you're in the money here. The question becomes, can they? I have no idea. To me, I'm not going to take that risk, but maybe you want to. Next one, Square, Block. This is a company that went to the moon. It is down 76% this year from its highs, and look at these 8 pillars. Just really bad. And this is the one that kind of worries me. They're a software business. You should have, well, I guess they do have hardware too, but you should have a higher than 2.1% ratio ROIC. This to me tells me how management reinvests money. That is a scary number for me. I do not like it. Now, they don't pay a dividend, which is not surprising. Let's see what analysts have to say. I have to think that they're going to see growth going forward, and they do. Earnings per share growth over 5 years, 67%, and 19% revenue growth into the future. The thing that I worry about with this company is the competition and the crypto. I think that a lot of these analysts are factoring in, and there's 25 of them in 5 years. They're factoring in crypto. I'm not factoring it in the same way, so I'm going to have to go lower than them. Probably not a surprise, but let's do a 5-year analysis on Block. Okay. They said 20. I'm going to go 15 on the high side. I'm going to go 8, and I will go 11. Profit margin. Man, it's amazing to me that there's, it's a software business. So let's go 15, 20, 5, 35. Price to free cash flow. Nah, that's way too high. Let's go 15, 20, and 25. Price to free cash flow. And I think that might be even too high. Guys, here's the common theme that when I type this in a stock analyzer tool, a lot of these companies are just massive speculation. Are they good companies? Do they have great products? Yes. But the problem is I can't fairly put a value on these things without speculating a little bit. So I'm going to go 15, 17.5, because I do think this company will be around in 5 years. Let's see what this comes out to. Again, if you believe my assumptions of 8 to 15% revenue growth over the next 5 years, then yes, we are in the money. But the question becomes, you need to do a little bit more research on this before you go. So you're going to find, guys, when companies fall 90%, you're going to find that yes, they're probably hitting your value, but there might be a reason they're hitting your value, and they could certainly go lower. Let's go to another one. Wayfair. This was all the rage during COVID. People were redoing their houses. They were buying new furniture, doing little projects here and there. They are down 87% over the last year, 36% this month. 8 pillars here. Again, another mess. They're not making money. They do have revenue growth. They're diluting the heck out of you. Their ROIC is absolutely terrible. They're not generating cash flow. A lot of these things worry me. And let's go to the income statement real quick just so we can see this explosion. Look at this explosion. In 2017, they were doing $4 billion. By 2020, they were doing $11.5 billion. It just doesn't add up. It just doesn't add up, guys. Let's go to the analyst estimates. Earnings per share, they see negative earnings per share in the future. And 5 years down the road, they're thinking 9.25% revenue growth. Remember, they're 9.25% from the numbers that they're going to be pulling back to. So if they're doing $12 billion in revenue, they go back to $4 billion. They can climb from that $4 billion level just to, they can't go down forever, I don't think. But actually, they could. So let's go with revenue growth, 3, 5, and 7. Profit margin. Again, issues. Let's go 5, 8, and 11. 5, 8, and 11, because these numbers should equal out over a long period of time. Let's go 13, 15, and 17. I don't think there's anything special about Wayfair that justifies some type of ridiculous PE. I'm going to go 15, 18, and 21. I would not be terribly shocked if they were not around in 5 years, but who knows? Again, guys, if you believe the assumptions that I put in, you are in the money again. Do I have to say it again? Question becomes, can they meet those assumptions that I put in? Next, Shopify. Shopify was the most disruptive company to come out of COVID, in my opinion, from what the media and the geniuses on Wall Street said. It is down 80% this year. Who thought that a company that was a processor for online stores was going to come down 80%? Well, we did. And it is down 16% this month. Let's pull up the 8 pillars. Again, a disaster of a company. $34 billion company. Current PE is sitting, well, they don't have a PE because they don't make money, so that's good. Return on invested capital is terrible. That is not good for a software business. Shares outstanding, they are diluting the absolute heck out of you. 34% more shares out there. The debt situation is really bad. I'm not going to harp on their debt situation because they're a newer company, but I am going to harp on their ROIC and their 5-year PE of 480. So analyst estimates. Now, when I look at analyst estimates and I think and I see this, 25% growth here and 1,100% growth in 2024, 151% earnings per share growth in 2026, I think to myself, all right, how could that be? Let's go to the income statement real quick and see the growth that they had. They basically more than doubled since 2018. 2018 in revenue, they did $853 million, and this year they did $5 billion. This is good growth, but they should be accumulating a profit at the same point. And are they? Net income? No. They made money last year, but they're back to losing money. They're losing about $2 billion this year. Are they doing any acquisitions? Am I missing something here? Not anything significant. So let's see those expectations again. 25% for the next 5 years of revenue growth. I mean, they've done pretty good job generating revenue. The question becomes, is it sustainable? And when are they going to turn a consistent profit? I don't know. Revenue growth, let's put in 18%. I'm going to go 12, 14, let's go 12, 15, and 18. Profit margin, it's a software business, so they should be generating pretty good profit margins here. I will go 15, 17.5, and 20. 15, 17.5, and 20. PE, they're not the only game in town, but 16, 18, and 20, they do have a great product out there, and they're on a lot of websites. 20, desired annual return, 15, 17.5, and 20. Let's see what we spit out. I bet this is going to be in the zone. Wow, it's not. So guys, look at this. I put in revenue growth of 18% over the next 5 years, a profit margin of 20%, and a PE of 20, with a 20% return on my money, and I'm still not in the money. That to me is very scary. This is something you need to go understand what exactly is going on behind the scenes. I do think that their numbers are going to come to fruition eventually, but it's not happening right now. And the last stock, Teladoc Health. This is a stock that has been absolutely battered and abused. And this is one of those that a lot of these YouTubers were saying, hey, you need to go and buy this. This thing's going to the moon. You had Kathy Wood out there. This thing is going to the moon. And it is absolutely not to the moon. It's down 78% in the last year. And if we come over here, look at this, guys. This is the 7th largest holding still in the ARK K Innovation Disruptive Fund. So let's get into this thing and see what you should be paying for this company, if anything. So look at 8 pillars. I'm assuming it's going to be bad, and yes, it is. Everything here is not good, except for their revenue growth. But this is a consistent thing that we're seeing, guys. You notice a lot of these companies have revenue growth, and that's kind of what sucks you in as an investor. It says to you, hey, this company is growing, but you got to go look at the other stuff. You got to go see what's behind the scene. Look at this, 196% dilution. So they have just taken your share of the company, if you own it, and just shrunk it down in a lot more than the day that you bought it. Now, let's see what the analysts are saying about this going forward. People are very high on this stock in the healthcare world. I am not, but that doesn't mean anything. Right now, it's looking at about like 16% revenue growth going into the future. Earnings per share growth is not there, but I'm more focused on revenue just because all of the numbers are kind of quote unquote hot mess right now. So let's look at Stock Analyzer. They think it's going to be 16% revenue growth going into the future. I think it's going to be, let's go 12 on the high side. So let's go with 6, 9, and 12. Profit margin. It is software, so let's go with 15, 17, and 19. I think that could be a little bit low, but I'd rather err to the low side with something like this than to the high side. 19% free cash flow margin. PE, let's go 16, 18, and 20. Same thing for price to free cash flow, 16, 18, and 20. And you guys might be saying that's really low. But you know what? This is not something that I just want to jump right into and own. So I want this thing to be a deal for me, if anything. And you might think that 15, 20, and 25% is a lot, but this is a big speculation company. I'm not totally convinced this is going to work. Now, if you believe the numbers that I put in, you are buying this all day. But again, are you actually buying these companies, all 5 of these, all day? Because all of them, except for one, came in and said, hey, it's all green. No. This is where you need to go and do more research. You need to understand exactly what you as an investor, where you're going to put your money, and are these companies going to be around and growing and profiting and not diluting the heck out of you in 5 years from now. You guys just saw that 4 out of these 5 companies just fell into my green range. I barely scratched the surface here. Go and watch this video right here. You'll see the 8-pillar process and how I get to these numbers. Catch you on the flippity flop.